This is the video for you if you want to understand adjustable rate mortgages a little bit better, or what we call ARMs. And basically what's happening with ARMs, a lot of people ask me today, interest rates are high. And people think, well, I think rates are going to come down, maybe I can refinance. So I'm willing to accept the risk of an ARM, of an adjustable rate mortgage, not having my rate fixed in for so long a time. And then they're surprised when they realize that there isn't that, the adjustable rate mortgages aren't really pricing that great right now. Now, why is that? And so this is what this is going to be about. It's not going to be about the mechanics of adjustable rate mortgages, about 5 years or 3 years or 7 years necessarily. I've got other videos about that. This video is specifically about the economics of an ARM and why aren't they pricing better right now? Why can't I get an adjustable rate mortgage and get a lower rate right now and then refinance in the next several years when I think rates are going to come down? And we're going to explain that here. So stick with me. So first of all, to understand the economics of adjustable rate mortgage, you have to first begin by understanding inflation. Inflation is essentially why adjustable rate mortgages exist primarily. And this here, you see, this is an actual chart of the value of a dollar from 1980 to 2020. Now this just happens to be a 30-year time frame. And what happened to the value of a dollar from 1980 to the year 2020? Well, we see it went from $1 down to here, it's about 28 cents, okay? And that's a substantial decrease. And think about this now in terms of, you hear about this, this cliche of the fixed income retiree and the plight of the fixed income retiree. And you can see this illustrated here. Understand that, if this retiree invested his money in 1980 and he retired and he needed to last 30 years, think about that. Think about that. That money in 1980, that dollar is now only worth 28 cents. And what a struggle that is to try and afford to live on your 1980 retirement in 2020 cost. And so if you're going to commit your money for a very long period of time at a fixed interest rate, you're going to give that money to somebody else. And that's essentially what you're doing. When you're taking a 30-year fixed rate mortgage, you're committing to having that money, someone's committing that money to you and guaranteeing you that they're going to have it at a certain interest rate. It's going to pay a certain amount of money over that 30-year period of time, no matter what happens to the cost of a dollar. And so this retiree would have to charge a premium, or would have to invest in a premium if he's going to invest his money and it's going to be at the same rate of return over 30 years. He's going to need to build in a premium to say, I know this money is going to devalue over time, and I need to build in a premium over that. And so the longer the term this money is committed for, the higher the premium and they're going to have to choose. Now, understand that the same thing happens with a lender. When a lender loans us money over a 30-year period of time, they're committing that money to you for 30 years. No matter what happens to the value of that dollar that you have to pay them back every month, you pay them the same monthly payment every month. Forgetting about taxes and insurance for a moment, just your principal and interest, you pay them the same every month. And so the value of that payment to them in year 25 is much lower than it was in year 1. And so they have to charge a premium. And that's why, generally speaking, you have a 30-year fixed rate that's higher than a 5-year ARM, for example, because they're committing that money to you over a longer period of time. And so that's the normal thing. That's the normal thing that happens, and we can kind of understand that, why that premium has to be attached to money that's committed for a longer period of time. But what happens here now? Why do ARMs exist? Why don't we just get cheaper rates for shorter mortgages and higher rates for longer mortgages, and that always be the case? Well, here's what happens here. Here's why an ARM exists, is that typically the investor has a margin that they want to make. Now the lender is a borrower too. They're not sitting on trillions of dollars. Fannie and Freddie aren't just sitting on trillions of dollars that they're just giving away or lending to us. And whenever somebody new comes along to buy a house, they just grab another out of their pile of trillions of dollars. They're borrowers too. They issue mortgage-backed securities and they borrow that money. And the same concept, the same principle applies to them as well. When they borrow money, the longer the term that the investors are committing to them to give them that money for, the higher the cost of that money. And of course, they have to make a profit. And so they're going to go out there and let's say they're borrowing at 5%, they're going to lend it to you and me at 7%, and that's their profit. That's their income or that's their profit, the difference between their cost of money and what they're lending it to you at. Now, what happens is when they go out and lend you money on a 30-year fixed rate mortgage, they're not borrowing on a 30-year term. And there's a very good reason for that. They're not going out there and getting a 30-year bond so they can turn around and loan us money over 30 years, and there's a very good reason for that. And that's because the average life of the loan is closer to about 7 years. They have this massive pool of loans, right? Fannie and Freddie loan the vast majority of mortgage loans in the United States every year. The vast majority of outstanding mortgage debts is backed by Fannie and Freddie. And so they have this massive pool, so they can play the averages. The averages work out, the bigger your pool is. They can play the averages, and the average life of a loan is closer to about 7 years. And so it's good for all of us that they don't go out and borrow on a 30-year basis and then loan that to us for our 30-year fixed rate mortgage, because if they did that, they're still going to need their profit. It's just that their costs would be higher, and so then our rate would be higher. So generally, they're going to loan, they're going to borrow on about a 10-year basis. They're going to issue a 10-year mortgage-backed security, and that fixes their cost for 10 years, and that covers them, right? That covers them because the average life of a loan is closer to 7, and so as long as that loan pays off within the average life of that loan, then they're going to make their profit margin because they've fixed you an interest rate for 30 years, that's not changing, and their cost is fixed because they borrowed on a mortgage-backed security. But what happens here, this is the risk that Fannie and Freddie face when they do that. What happens if you are one of those people who don't pay it off in 7 years, in 5 to 7 years? Let's say you're one of those people who keep that mortgage for a very long period of time. You're going to be in that house for a very long period of time. And now, their cost of money has to change. Now, let's say, we went back, we've seen what's happened to interest rates over these last couple of years, right? 22, 23. We've seen interest rates skyrocket. So when Fannie and Freddie loaned us money in 2022, late 2021, early 2022 at very low interest rates, now you keep that loan for longer than 7 years, they're going to have to go out and reprice that. They have to pay back these mortgage-backed securities that they borrowed money on in order to lend that money to you. They have to replace that because you haven't repaid that loan. Now again, these aren't the averages, but that's where that risk does exist for them. So they have to reprice that money, and now you're sitting here, you're still at your 7%. Now many of us, if we borrowed money in 2021, early 2022, we're more like 2 or 3%, very, very low interest rates. And now Fannie and Freddie have to go out and they have to issue another 10-year bond, or however many year bond they're going to issue. And you're going to see here, now they're losing money because they're still charging you money here now, but their cost of money has been reset to here. And that's the risk horizon. This is what you call the risk horizon, because for that first 10 years, their interest rate is fixed, their cost of borrowing is fixed, and your interest rate's fixed for 30 years. So there's no risk to them during this period of time. They're going to make that profit on what they charge you. You may sell the house, repay the loan or whatever, and then they lose that profit, but there's no risk that they're going to get into that loss situation. But what happens when you do keep that money beyond that 10-year horizon? They have to go out and reprice that. Now they're suffering a loss, right? That's their loss. And this is why adjustable rate mortgages exist, is because they can give you the option of transferring that risk to yourself, of taking that risk to yourself, removing it from them, and then they can give you a cheaper interest rate. And so that's why in a normal rate environment, adjustable rate mortgages are cheaper, because basically what an adjustable rate mortgage does is it says, it's not that they're saying this is just a 5-year mortgage or a 10-year mortgage and you have to repay it in 10 years. It's a 30-year amortizing mortgage, but we're going to reset the rate after 5 years or 7 years or 10 years. And so what that does is it transfers this risk here from Fannie or Freddie, who's loaning you the money, to you, because now at 10 years, yes, they have to go and repay that pool and reprice that money, but then they also get to reprice your loan. They get, and of course there are limits on how much they can do in any given adjustment, and it's tied to indices that track how the general market's doing. They can't just do it willy-nilly, but they do get to reprice that money. And so if they got in that environment, and many of you have kind of discovered that if you got an adjustable rate mortgage back when rates were really low, and now you've kept it that 5 years, and now they're adjusting, you felt that pain. That's where that risk exists, right? But that risk is being transferred to you. You've absorbed that risk by taking an adjustable rate mortgage. You've eliminated that risk to Fannie and Freddie, and as a result, they no longer have to price in that premium. They can give you a lower interest rate because they know after 5 or 7 or 10 years, however long you fix that rate in for, however long that adjustable rate, that fixed rate period is on that adjustable rate mortgage is, that's going to reprice, and that's going to eliminate that risk. And so that's how you benefit from an adjustable rate mortgage, is you transfer that risk to yourself. And sometimes you do that just because the European countries by and large go by adjustable rate mortgages, so they're in general just way more comfortable with that. But also you may know something about your plans with the house. Your plans with the house are very limited, and you're only going to be there for 5 years, so you're happy to take on that risk. For whatever reason, you're willing to absorb that risk of that adjustable rate mortgage. So what about now? Now we talked about at the beginning of this, why aren't adjustable rates working that way now? Why can't I get an adjustable rate mortgage right now? Now, remember how we introduced this concept. We introduced this by talking about this hypothetical person who's thinking, I'm willing to take an arm. Maybe I normally wouldn't, but I think rates are going to go down in the future. And so I'm willing to take an adjustable rate mortgage right now because I think there's a pretty good chance that rates are going to go down and I'll refinance into a fixed rate then. And the problem is investors know that too. Okay? And so what happens, this is an example of a yield curve. Now it's exaggerated. This is exaggerated, but basically this is the term and this is the yield or the cost of money. This is cost of money. Okay, so a normal yield curve, and remember this is just in our 30-year fixed rate example before. This is just a different graph on the same basic axes, right? We have term over here. This is years. And we have yield as percentages. This is, let's call this 3%, and let's call this 5%. The numbers aren't super important in terms of what specifically are. What matters is in a normal yield curve, let's say you're fixing the rate for 5 years, or 10 years, or 20, or 30. Normally, so the longer term the mortgage is guarantee you that rate, the higher the rate you're going to charge you, right? So if you have a short term of 10-year, it doesn't have to be an adjustable rate. It can be a fixed rate, a 10-year fixed rate. That's a fully amortizing 10-year loan. You're going to be charged less money, again, because that lender's risk is less. That lender's risk, the risk of inflation eroding the value of that dollar is less because it's a shorter period of time. So they're able to charge you less. But if you want it that full 30 years, then they're going to charge you out there. They're going to charge you a higher rate because they need that premium. And so that's what produces the normal yield curve. What happens here is called an inverted yield curve, and that's what we're experiencing right now. And an inverted yield curve happens when people expect rates to come down. And this is one of the reasons why people who tell you, look, nobody should be telling you right now, look, just buy now. For example, I'm a mortgage guy, I'm in real estate. Realtors will talk about buy now, rates are going to come down, and you can always refinance later. Nobody should be saying that, right? Because nobody can guarantee that. But you know that it's widely expected and objectively expected across the whole industry because you can see the behavior of the yield curve. And the yield curve is operating like this. Now this is exaggerated again. It looks a little bit more like this, maybe a little bit more like this. It's really kind of closer to one another, but that's still more pronounced than the normal real yield curve. It is an inverted yield curve, and the reason for that is everyone expects rates to go down. And because everyone expects rates to go down, when you are investing your money in a bond and it's going to pay you for a certain amount of time, you're willing to take, if you expect rates to go down in the future, why would you commit your money to someone to say, well, I'm going to incentivize you to take this over a 5-year period. I'm going to pay, I'm going to charge you less over that 5-year period because you as the investor, the lender who's lending you that money will expect, hey, rates are going to come down in 5 years, so I'm giving him this 30-year mortgage, but with a rate that adjusts in 5 years. But my expectation as a lender is that rate's going to come down in 5 years. So I'm giving you this money now, and in 5 years, you're going to be paying me less because I think the market's going to come down, and this adjustable rate mortgage, it does go both ways. Adjustable rate mortgages adjust both ways. They go up and down depending on what's happening to the market. And then you as an investor, just think about an investor how you're willing to take a lower interest rate for a longer term investment because you expect rates to go down too. So if you expect rates to go down in the future, then you're willing to say, hey, I want to lock in today's rate on 30 years or a longer period of time because I expect rates are going to come down. So I'm going to incentivize the long end of the curve by accepting a lower return on a longer term investment, or in this case, in the case of a mortgage, I will accept a lower interest rate on a 30-year mortgage because I expect rates to come down and I want to lock in the rates where they are now for a longer period of time because I do expect rates to come down. So that's why you see right now investors, lenders aren't incentivizing ARMs. They aren't incentivizing you to take an adjustable rate mortgage right now because they expect rates to go down just like you do. Just like that's one of the reasons you might be willing to accept an adjustable rate mortgage right now. And there's no reason for them to do that. There's no reason for them to incentivize you to do that when they expect rates to go down into the future. So right now, you're really not getting a deal on adjustable rate mortgages. So anyway, I hope that helps. And I hope you like this video. If you like it, please like, subscribe, leave me a review, ask any questions you want. We're licensed in Washington and Idaho, but most of these principles apply across the country, so feel free to reach out with questions. And I can always refer you to a quality broker anywhere in the nation if I can't deal with it directly. Thanks so much.